In this video, we're going to go over 6 stocks that may be a great buy for 2021. We have a combination of growth stocks and dividend payers, and we have companies from various sectors of the market. And how I came to these top 6 stocks is by going through this article. This article right here lists 21 different companies that they believe are a great buy for the next calendar year. Going through this list, I found that a lot of companies don't have the financials or don't actually have the growth expectations to be warranted for a buy for 2021. So I went through this list and chose 6 companies that I actually believe are some top players and will see some high growth rates into the next calendar year down the road. If you're new to the channel, everyone, I am the Gen Z investor, and every single day we talk about the stock market. We go over different stocks you can buy and sell and discuss any stock market major news and headlines. And in this video, we're going to go over the 6 different companies, discuss their current share price, their current financial position, and some reasons why we think they're going to grow over the next year. And these companies may be a nice buy into your portfolio right now. I'm not saying that any of these companies are at a fantastic price or they're super over or undervalued right now. I'm just going over companies that I believe are going to have a very strong 2021. Regardless of their fluctuations right now, I think these are companies that are going to be much larger, see increased revenue and earnings over the next year, and we may expect a share price to be higher than where they sit today. So please hit the like button, subscribe to the channel for daily videos about the stock market, and we're going to jump right in to stock number 1, which is Alibaba, one of the largest companies in the world with a $690 billion market cap. They are one of the leader in the technology and e-commerce space within China, and they have some high future growth expectations. If we take a look at their company, they are traded under ticker BABA and currently sit around $260 per share. The company is up over 24% over the past 12 months, but if you take a look at a shorter term perspective, they have seen a massive pullback as of late. Going over their 6-month chart, from their 52-week high, you can see a pullback of over 17%, down $55 per share to where we sit today. So I think we're at a nice point in the share price that this may be a nice addition to a portfolio. If we take a look at Alibaba, over the longer term, they're up more than 200% on the 5-year chart. They're growing tremendously, and they currently trade at a forward PE just over 24. And on the 52-week range chart, you can see they're trading on the center. If we take a look at some of their future growth expectations and how they've been performing, we'll go over their latest earnings. Over the previous 4 quarters, they have absolutely crushed analyst expectations, beating on EPS by 35 cents, 43, 18, and even 65 cents in the last quarter. And over the next year, we still have some very high year-over-year expected growth rates of 27%, 57, 40, and 7% over the next 4 quarters in the future. And Alibaba has beautiful growing financial statements. If you take a look, top line revenue back in 2016 ended the year just over $15 billion, but now in the past 12 months, they brought in over $86 billion of total revenue, which is absolutely incredible. And year over year, they're beating their previous records, setting new all-time highs and growing at an exponential rate. And this company is still extremely profitable as well. Net income for the business at over $19.4 billion over the past 12 months, which is absolutely incredible. And their balance sheet is flawless as well. They have over $60 billion of total cash on the balance sheet right now. And if we compare just their cash balance to the liability side, you can see they can almost pay off all of their liabilities with the cash balance. Total current liabilities of only $38 billion. So right now, they have a current ratio well above 1 and very sustainable. Total assets on the entire balance sheet set at over $211 billion. Compare that to the total amount of liabilities at $67.8 billion. Again, a beautiful overall ratio. Not a lot of worry about their short-term or long-term financial health. And analysts are expecting big things from Alibaba. Next year, we're expecting 31% annual revenue growth, and that's absolutely incredible. For a company that already brings in over $86 billion of revenue, a 31% growth rate would be insane. And this company is rated as a strong buy. If we take a look, coming in at a 1.6 in that strong buy rating, and the current share price of $260 is well below the average annual price target of $338 over the next 12 months. So a ton of upside potential, and analysts expect this company to reach a new all-time high. So that was the first company in today's video, was Alibaba. This e-commerce platform has seen a massive pullback as of late, but they continue to reach new all-time highs, and I think the company will continue to grow for many years down the road. On to stock number 2, we have Microsoft, another major player on the market that's only expected to dominate for many years down the road. They have a market cap at around $1.6 trillion and are expected to grow by around 15% per year over the next 5 years, and that's incredible for such a large company. Ticker MSFT is one of the largest companies in the world. They are up 38% this year and currently trade at a forward PE at 31.8. The company does pay out a dividend and it yields just over 1%, and this company is still one of the major players that has some high future growth expected down the road. And their cloud services are really what's going to lead the future growth, and they have been absolutely exploding throughout 2020, and the demand is only expected to continue into 2021. Even during a global pandemic, this company was able to raise revenue by 12% over the past quarter, and net income grew by 30%. And if we take a look at some of their cloud products, they were able to grow substantially over this past year with very strong increase for future growth. If we take a look, their cloud services grew 9%, 21%, LinkedIn grew 16%, and the big player is the Azure platform, which grew 48% over this past year, which is absolutely insane, and that is one of the main players that really helps drive up their bottom line. They have a beautiful income statement as well, top line beating new record highs each and every year, but one thing I want to point out is their net income. They brought in over the past 12 months $147 billion of total revenue, and compare that to their net income of over $47 billion. This company has very high profit margins of around 30+%. The business is incredible, and this profitability allows them to pay out a growing dividend to shareholders, plus buy back a ton of shares, really driving up investor reward. And if we take a look at their future expected growth, over the next 5 years, we're expecting 14.5 per year perspective growth. And if we take a look at the stock price, it is considered a strong buy right now, coming in at a 1.7, and the average price target for the shares sits at close to $240 over the next 12-month span. Now moving on to the third stock in today's video, we have ticker UPS, United Parcel Service. They currently trade for $170 per share and are up 40% this year. This company has a market cap at $144 billion and is expected to see some beautiful growth over the next year. As we shift to purchasing more items online, all of those items are going to be delivered. And one of the main players in that delivery space is, of course, UPS. So although they've seen a good run up this year, the demand for their growth is only expected to reach record highs over the next calendar year. And because there aren't a lot of companies with the infrastructure set out to deliver packages all across North America, they are one of the main players that's going to remain a market leader for decades down the road. Although other companies may try to compete in that space, UPS is already so large, so well diversified that I believe they will continue to grow at a nice, beautiful rate over the long term. And this company does pay out a nice little dividend, currently yielding 2.4%, a payout ratio of only 52% of their earnings, which just means there's a lot of money staying back in the business to reinvest and grow, plus that gives more room to grow that dividend payment to investors each and every year. They average over 7% annual dividend growth, and they've been growing their dividend for 11 consecutive years, which is great to see. And on to stock number 4, we have Bank of America. We all know the financial sector got absolutely crushed in March of 2020. Banks dropped 30, 40, 50% in the matter of weeks, and we all thought the financial industry as we know it was over. These companies provided billions of dollars in loan loss provisions, getting ready for some massive deferrals. But that really didn't happen, and now banks are healthier than ever before. And if we take a look, the bank's financial position is actually so strong that there isn't much worry about any kind of financial hardship coming anytime soon. And Bank of America is poised to see another upswing back to pre-pandemic levels and beyond. We saw other financial companies so far over the past month, like JP Morgan, come back and reach closer to their pre-pandemic highs. But Bank of America hasn't done that just yet, and they still sit down 16% on the 12-month chart. They have a market cap of $247 billion and currently yield 2.5%. And you can see on the 52-week range, they are trading towards the center. And I think this company can continue to grow. For all of you who have been following along with my personal financial freedom portfolio, you know I am bullish on financials, especially when Warren Buffett spends tens of billions of dollars investing into financials, especially a company like Bank of America, where he owns a significant stake of this overall business. I believe there is some room to grow, and I do think we will see shares over the next year reapproach the pre-pandemic level at around $35. If we take a look right now, they currently yield 2.5%, a payout ratio of around 41% of their earnings, and they have a massive dividend growth rate, averaging 40% over the past 5 years. Of course, that dividend growth rate is not sustainable over the long term. Once they were forced to cut their dividend back during the financial crisis in 2008 and 09 and past that, then they've been growing it rapidly to get back to where it once was. I don't believe we will see that great of a rate down the road, but I do think once this company is allowed to continue to raise their dividend, they will do it at a very fast rate and investors will be very happy with what they get. So Bank of America, I think, has a lot of room to grow over the next year. I think once the financial economy comes back, we have a vaccine hitting the market right now. Hopefully that can bump up the economy over the next year. And in 8 to 24 months, we will see a nice recovery and Bank of America stock will be back to reading record highs. Now on to number 5. We just took a look at a traditional bank in Bank of America. Now we're taking a look at a digital payment solution, which is PayPal. This company's been growing at a massive rate, and they actually have a market cap slightly above Bank of America at $259 billion. The company is up over 100% this year, and shares have exploded. And PayPal is doing a nice job of adapting to the current market conditions. As more people spend money online, PayPal helps facilitate those transactions. They're a market leader, and they provide a very safe and secure wallet to allow individuals to confidently buy items from digital platforms. And PayPal has done a beautiful job of expanding. They're a household name. They make a lot of acquisitions into smaller fintech companies to help them grow. And I believe some of their smaller subsidiaries are really going to help the overall umbrella of PayPal really develop over the long term. So this is a growth company, of course. They do not pay out a dividend, and they're expected to see some huge growth down the road. If we take a look over the next 5 years, we're expecting 23% per year growth from PayPal. And taking a look at the buy now rating, coming in at 1.9, it is considered a strong buy. And PayPal has seen some beautiful financial statement growth as well. This company has seen massive top line boosts, and over the past 12 months, they've brought in over $20.2 billion of total revenue. Each and every year, they're hitting new highs. And if we take a look at their bottom line, that's what's impressive about the business as well. Over $3 billion of net income, and each and every year, net income continues to reach a new record, which is absolutely incredible. So another company that I think is going to have a strong 2021, like I mentioned at the very beginning of this video, I don't know which companies are overvalued and undervalued. That's not really how I evaluate a company. I take a look at where the share price is today, and if I believe in my heart and from my research that the company is going to be larger and the share price is going to be higher over the next 5, 10 plus years, then I choose whether or not I'm going to buy. I really don't care if it's really overvalued or undervalued at the current price point because I hold all of my personal holdings over the long term. So a little bit of fluctuations on where I buy in is not going to make a difference over the next 5, 10 plus years. So PayPal is stock number 5, a very strong company. I do love it. I've been talking about them for a long period of time. They're getting into some other very interesting aspects as well, such as the Bitcoin space, which is really going to expand in 2021 because they're going to be the first and largest financial institution to allow you to buy, hold, and sell Bitcoin within your digital wallet. And they're going to allow you to use that Bitcoin to make purchases at over 20 million digital retailers, which is the first in the entire world. Not many players are doing that, and PayPal is set to explode off of this new expansion. Now, finally, on to stock number 6, we have Intel. This is a semiconductor company that has had a very tough year in 2020. The share price has been hammered and is down 12% over the past 12 months, and you can see a lot of downward declines from Intel over this past year. They currently have a market cap at $207 billion, and if you were taking a look at which companies are at an attractive price point, Intel may be the best one on this list. They are a dividend payer, currently yielding 2.6%, and a very low forward PE at just over 10.3. On the 52-week range, they are trading towards the back end, lower to the 52-week low. And overall Intel, within the semiconductor brand, we all know this company has had some hardship, seeing some huge declines and some huge issues with some chips. But if they are able to recover, this may be a great point to buy in over the next year. Overall, the semiconductor industry is expecting record growth over the next 5 years. We're expecting high double-digit growth rates from the sector as a whole, and Intel, if they can remain a top player, will see some mass expansion. And along with that potential for share price growth past their current 52-week high, they also have a nice 2.6% dividend, very low payout ratio of only 27% of their earnings, so the dividend is sustainable, and they grow their dividend at close to 7% per year, which is great to see. So another interesting company, with terms of valuation, they might be the best player, but overall a semiconductor brand that may surge over next year if they can rebound and get their operationals back and going. So those were 6 different companies. I took them from that massive list of 21 different names. Overall, this list had a bunch of companies that I actually don't think are going to see much growth. They had a lot of smaller cap companies with a $1-2 billion market cap that I don't think are going to be sustainable and actually worth my discussion on this channel. I like focusing on brands that I know are going to expand, or at least have a high probability of doing so. So that's why I went through the entire list of 21, picked the top 6 names. These are all companies I'm sure you're all aware of. They're all major players that I think are actually going to see a very positive year in 2021. So thank you for watching. Please hit the like button, subscribe to the channel, and see you in tomorrow's video.